Today is Sunday, June 21st. This is a review of the stock market of the week that was and an outlook for the week to come. Those who started following me understand that I nailed the market action here, market moves and the reversal that we've seen on Friday, and I will remind everybody of what I said on my video on Thursday, June 11th, well before the week even started and well before the reversal that we saw last Friday, June 19th. Here's what I said. So the bias right now is to the downside. The bias right now is for the profit takers. They're selling their stocks, they're taking profits, so does the joiners who joined during this rally. So the bias is to the downside in the short term. Therefore, any bounce we see, whether it's going to happen tomorrow or next week, that's an opportunity to sell and take profits. Okay, so this was recorded on June 11th, and we said that any bounce that could happen next week, meaning the week that we had, is an opportunity to short the rip and an opportunity to sell and take profits. And we were right. I was confident in my strategy, and I actually doubled down on it later in the week in this recommendation. In conclusion, we remain cautious, we remain bearish, and we continue to buy the VIX to protect our long portfolio, and we continue to short the rip in airline stocks and weaker stocks that are being pushed by day trading or in gambling activities. These names are weak, they have no merit to go up. To help you understand how I got to this conclusion, I will walk you through the indicators that I used to make my conclusion. Those indicators are the dollar index, bond prices, the volatility index, the relative strength index, the Fed liquidity action, and finally the XLF, the financial ETF. I looked at these indicators. I've been tracking them since before the week started, and I've made a conclusion that the bounce that we're going to have at the beginning of the week is worthy of shorting. It will reverse at the end of the week. So I will show you in these clips what I said earlier in the week about each of these indicators and how they will unfold the market action during the week. I will have a timestamp on each of these clips so you can go back and watch the videos in its entireties if you're interested. So let's look at the dollar index and see what happened from a daily perspective. Did we have a confirmation from the move that we had last Thursday? Yes, we did. That tells you that there is a movement to sell stocks and raise cash. It's still small. It's still not as big as the leg that we had during the market correction in late February, but it is of notice. You have to keep that in mind, that we're raising cash here, and the dollar index is crossing its moving average in the MACD indicator, which is bullish for the dollar index, not good for the stock market. Same story with the TLT. TLT closed a big day today, over 1% positive. Now remember that the TLT is a little bit of a canary in a coal mine type of indicator because it moves a little before the stock market. So we have to keep an open mind here. If there's demand on bond, the cash to buy bonds has to come out of somewhere. And the ATM right now is the stock market. It went to all-time highs, at the Qs at least. It's overbought in many areas in the stock market. A lot of people assumed, if you were assuming if you were in the V recovery camp, your assumption was that the VIX is just going to explode the upside, collapse all the way down to its normal range. But that doesn't usually happen when you have a big breakout in the VIX. Let me show you an example here. The closest example we can go back to is the 2008-2009 financial crisis. And here's what happened. You have your big primary move, and then it cools down, it goes back to normal range, and the second aftershock right there before it goes down again. Another big move, here we go, 2016, big explosion to the upside, primary move, cools down, secondary move right there before it goes down to normal ranges. So we can assume that this move will repeat history and have this big primary move going down, cooling off, and another secondary move at minimum before we go down and trend down again. So this is what the VIX chart looks like this morning on a weekly perspective. If we see any sell down to the downside, we'll be buying the VIX in its proxies, of course, because I believe that there's another bigger secondary move, bigger than this candle alone. The other thing I want you to pay attention to, back in the 2009 crisis, the VIX went down to its normal range. It retreated all the way back to its normal range before the secondary move. Here, in the move that we have right now, it never got back to the range, to the normal range. And that keeps me up at night a little bit, that the market recovery isn't really as good as it's being sold out to people. What I want you to pay attention to here is the RSI. I don't usually look at it from my trading practice in a normal market. I look at it when there is a big market correction, big market move. It becomes handy. And when you take a look at the move we've done in this leg before the market crash, look at where the peak is in the RSI indicator. Compare that with the peak from this last move that we've done. We're at a lower high. When did we see this before? We've seen it here. The peak in January 2018. We made a higher high in the RSI. And then we actually made a higher high on the chart, even though we made a lower high in the RSI. And what happened next is a big movement to the downside. Now let's take a look at the Qs, see where they are. And the Qs, even though they made a higher high on the chart, you take a look at the RSI again, and it's making a lower high compared to the high or the peak it made before the market crashed in late February. The RSI measures the top peaks and valleys of a certain move. And what it tells you basically, if you look at this move right here, let me turn off all these lines right here. When you look at the move here, it was mostly for green candles. It was mostly institutional buying and accumulation of stocks. When you look at the move here, there's more volatility. There's more selling, there's more profit taking, there's more short covering, there's more speculation. So this move is a lot weaker than the move we had here. Usually, where did we see that before? Again, we've seen it 2018. The Nasdaq made a top here at the RSI chart in January 2018. And even though it made a higher high by October, it made a lower high on the RSI chart. And we know what happened next, the correction. Anytime you have a weaker move, even though you made a higher high on the chart itself, you need to look at the RSI to see if there's a confirmation. Is this move really as strong as it is? Every stock in the index is participating in this move, or is it just certain handful of stocks that push the index to higher high? And you can do that by looking at the RSI indicator. So I'll leave you with this clip, again, a reminder what Jerome Powell said. Listen to it carefully.
What's the exit strategy on this?
So I certainly hope it doesn't have those negative effects you mentioned. This is something we said we would do at the beginning, and you pointed out that markets reacted very strongly to the announcement. That's because they believe that we'll do what we say we're going to do. So one reason, I wouldn't say it's the main reason. One reason is though we feel that we need to follow through and do what we said we were going to do. So
the market recovered based on mere psychology that the Fed has our back. Jerome Powell says, yeah, we got your back. We're going to buy bonds. We're going to buy all the ETFs that tracks the bonds, therefore the stocks of companies. However, they're not going to do it when the market is already at all-time highs, specifically a lot of stocks, all-time highs. They will wait for a better entry into the bond market. So be careful, because when holders, people who bought the hype that the Fed will have our backing, they keep buying and buying and buying, hoping to sell to the Fed for higher prices. When they realize that, hey, the Fed is not going to buy at these prices, you're going to see panic selling, and then the Fed will enter to rescue the market. This is why, the main reason why I remain bearish for now. Remember, the XLF that tracks the banking sector, it never really made a higher high since the financial crisis. It never really recovered. Here's the peak in 2007. Here's the peak from 2020. We never really recovered in the financial sector. And this is a big reversal candle. There's more pain to come in the banking sector. And if there's more pain that will come to the banking sector, there's more pain coming to the stock market. Okay, we're live. I'm not showing you any more past clips here, but the reason why I showed you all these clips is to take you through the mind process that I go through to make these statements and make these decisions. It's not a gut feeling. It's not my tarot cards. It's not the lunar eclipse that told me to do so. It is a process. It's a logical process to look at certain indicators and make decisions. With that being said, here's a little bit of mind trickery for you. This could be a mere coincidence, but if you've noticed the thumbnail from my last video on Thursday, June 18th, right before the day of the market reversal to the downside where we closed, you'll notice that the title on the thumbnail starts with green words, and by the time you read it, it ends with red words, just like the market's action on Friday. It started green and it closed in the red, deeply in the red. Did I know that? Did I did that intentionally? Maybe and maybe not. I'll leave that for you to decide. Moving on, the day started very slow, very quiet. We didn't have any major headlines. Certainly no vaccine headlines. Maybe we'll see one on Monday. But there's a reason why I don't trust those vaccine headlines, because remember the headline that we got last Monday, at the beginning of the week, about the steroid treatment in the UK that was very promising, and that was the excuse for the market to rip higher. And now we had a correction that, hey, we should be careful about being too optimistic about this treatment. Basically, they threw cold water on it, just like I expected. So I don't take these headlines seriously at all. But some traders do, especially during the futures. It's maybe a mere coincidence, but these headlines always hit during the futures to prop the market up. The second thing to keep in mind before the day started is the number of COVID-19 cases been rising in a lot of places in the country. I'll show you a bunch of charts here from Time magazine for states that opened up and the cases reversed back to the upside, and states that opened up and the cases are still rising. They never dipped to begin with. So here's a look to some charts in the states. And one more thing that caught my attention is the lines for unemployment in Kentucky. It was absolutely disturbing to see how huge the lines are for people just waiting to ask questions about their unemployment benefits. It's absolutely disgraceful, and it absolutely shows that the economic crisis that we're in is way, way deeper than any of the pundits or the personalities in this administration, certainly like Larry Kudlow, is trying to sell. Kudlow goes on television and says, hey, we're seeing a very steep V-shaped recovery.
I mean, does this get in the way of the V-shaped recovery that you and many in the markets are hoping for?
Well, I don't think so. Now, look, there's so many green shoots coming up. I think it's going to be a very steep V recovery.
Really? If we're seeing very steep V-shaped recovery, why are we still getting over 1 million people filing for unemployment benefits every week? Why are we seeing these scenes of people lining up for miles and miles waiting to ask questions for unemployment and file for unemployment? It's absolutely disgraceful. It's pure propaganda. I don't know what Kudlow's drinking these days, but he's obviously way off and not even worthy to listen to. The crisis that we're in is being unfolded right in front of us. That it's worse that we're being told. And the stock market ripped all the way higher, ignoring all the facts and all the things that we're seeing here in Main Street. There is no V-shaped recovery. A reminder of a tweet I put out on Thursday that there's a big move imminent in the stock market, and that big move happened the day after on Friday when the market reversed its gains and went closed on the red. Here's a 15-minute chart on the SPY. Opened higher, we gapped higher at 314, almost 314. And we kept selling off and consolidating here at this level. And there's, you see, the big candle downside. This candle happened, the sell-off right here, because we found out that Apple would close their stores in many states like Arizona and the Carolinas. That certainly doesn't jive with the V-shaped recovery. That tells us that things are getting worse, and the economic activity will slow down again. Consumer spending will slow down again. Companies are going to start closing again. Not good for the stock market, and you see the shock of the sell-off immediately. However, the dip buyers, they think that this stock market is just going to keep going up and up and up. The Fed will flood the market with tsunami of liquidity, and that's why you should just buy every dip. These guys are going to be proven wrong, but they're notorious right now. They're just going to buy every dip there is. They buy the dip, and right around here, right around 10 o'clock Pacific time, 1 o'clock Eastern time, Wall Street time, I put up this tweet that the dip buyers will get smoked. They didn't listen to me on the cruises and the airlines. They keep buying the dips, and they got smoked big by the end of the day. Here we go. We go down. Another dip buyer, of course, the certain personalities of the gambling crowd are encouraging people to buy the dip. They buy it, push it up a little bit, and by the end of the day, big reverse candle. If there was any more time left, it would have continued to the downside, but certainly not a good sign here. It tells you basically that there's more sell-off to come on Monday. So what do we see for this upcoming week? For us to be bullish, we need a big move to the upside, a reversal of the upside, We need them to close the gap right here, which coincides with 318.22. That also coincides with the upper half of the candle, the reversal candle on the futures contract. We need them to close above here and keep marching the upside. You need to beat these levels. You need to close above them on a weekly basis. Otherwise, all bets are off. The likelihood is that this was a primary move, a counter reaction right here, and then we're going to continue on the same path of the primary move to the downside. And I will remind you of what I said earlier in the week in terms of my prediction of where the market will go. Very decisive week. Who's going to win? The bulls have to take the market all the way to the highs right here by the end of the week. If they fail, expect more continuation of this move. The primary move, a reaction, and then a secondary move to the downside. And my target is 286. This was a call on the medium term, of course. There was a more bearish call for the long term. Here it is earlier this week. The last thing I want to show you in this video is look at this trend line, the yellow line. It goes all the way to 2009, the bottom of 2009. We touched in 2009, again in 2011, one more time, 16, again in 18. And we pierced through it during this correction, which is not a good sign, but maybe this was just an overshoot. It is a safe assumption that the SPY would go down and touch this line again before it bounces. It's not going to happen in 1 week. It could, but likelihood that it's going to take a couple of weeks or a few weeks to go there in a sustained market correction. But we'll see how that works out. If you found this video helpful, please subscribe, share, and like. And don't forget to follow me on Twitter for the latest updates. Thank you.